On today's show, I'm speaking with Brian Burke, the CEO of Praxis Capital. He is a real estate veteran who has acquired over $1 billion worth of real estate, including more than 4,000 multifamily units and 700 single family homes. I'm Kathy Fettke, and welcome to The Real Wealth Show.
You're listening to The Real Wealth Show with Kathy Fettke, the real estate investor's resource.
Brian's been through every kind of market cycle and built his success by staying disciplined when other people were losing focus. In this episode, he shares what decades of experience have taught him about knowing when to invest and when to sit on the sidelines. We'll dive into recession risk, the state of multifamily, and the next frontiers of real estate investing, including the growing opportunities in senior housing. Brian, welcome to The Real Wealth Show.
Kathy, I can't tell you how glad I am to be here. After all this time, my first appearance on The Real Wealth Show, I feel like I finally made it.
I feel like a dummy. I just cannot believe I've known you for so many years and this is your first time. So our listeners are in for a treat. So you and I were just on stage at a big event and kind of a Shark Tank, I think pitch slam is what they called it. So you were pitching your assisted living senior housing fund. I was pitching our new multifamily fund. Rich and I went first. I think we did pretty well. A lot of the audience wanted to hear about multifamily. Then you went up and I was like halfway through, I surrender, just give it to him. He wins. So Brian, I'm excited to hear what you have to say. But before that, you've done a lot of funds, you've invested in multifamily, but let's just go back for a minute to what brought you into real estate to begin with and what you were doing before.
Oh my gosh. Well,
A long time ago.
Yeah, that was 36 years ago, Kathy.
Oh boy. Okay.
You're starting to make me feel old. So I read this book that said that you can buy real estate with no money down. And I thought, well, I don't have any money. This is perfect for me. I don't know anything about real estate. I don't know anyone in real estate. I don't have any money. I don't know anyone with money. So I figured since I'm fully equipped to be a real estate investor, why not give that a shot? And so I did. And I bought a house and rented it out and then bought another one and flipped it and then got into the flipping business. And I was just hooked. And, the early years of my career development was all single family, fix and flip and rentals. And I thought that was great until I learned how to do multifamily like 25 years ago. And that pretty much changed my outlook on real estate completely, and then built a big multifamily business where we owned thousands of units until we sold most of them right before the market just crashed, which was good. I think I've done every sector of real estate, from multifamily, self-storage, ground up development, subdivisions, you name it. I've probably done it or tried it and figured out that I know what I'm best at, and I kind of stick to that now.
Yeah. I mean, gosh, there's so much I want to unpack there. How did you get your first property with no money down?
Well, the book said I could do it. So I thought okay, it's got to be easy, right? I learned later on it's not quite as easy as you would think, but it was easy for me. I mean, I just got lucky. I had a finance company that gave me the, 80% mortgage or whatever. And I asked the seller, I said, I don't have any money. Would you carry back the down payment? And they're like, yeah, we would do that. And I didn't realize later that's a unicorn, right? It almost never happens, or at least doesn't happen very often. But they did. Yeah. They carried back the down payment, and I made payments to them, and I made payments to the lender. And then when I sold, everybody got paid off, and they were all happy. So I guess every once in a while it works out.
Well, that type of thing works out better in a market where the buyer has more power and sellers are having a hard time selling. So we're kind of in that world right now. Who knows? Maybe people can go out and do it. I don't know how to do it, but you did it, so others can too. But
I was young and I didn't know any better. And I think that's probably the best time to do it, is when you read a book and it says you can do this and you believe it and you don't know any better, you go out and you do it, and by God, you do it.
Just go out and do it. Yeah. Me too. Get as much information as you can. Try it. What are you going to lose? I run into you often at different conferences. We're usually there speaking. I always want to hear your perspective on things because you've been amazing at timing the markets. Except maybe in 2008, you might have learned some hard lessons there, which is probably why you're really good at timing it now, would you say?
Well, I think that had a lot to do with it. I certainly learned a lot of lessons in '08. And, I was really fortunate, actually. I almost stopped buying all real estate in 2006 because it just seemed like it was getting way too overheated. And so even though I learned a few hard lessons, it could have been so much worse, because at least I saw that the market was getting overheated and backed off. So yeah, I had some pain in some things I was in my personal portfolio of commercial real estate, which it was rough, and learned so many things I don't ever want to experience again, but managed to stay through it intact. And I think the best thing about it is I didn't lose any investor money at all. And that I think was the big deal. And in fact, all the things my investors were invested in did pretty well, because it was mostly house flipping. And guess what? House flipping was great during the great financial collapse. But, all the things I was doing on buying and holding stuff with my house flipping profits, boy, was that painful. I mean, it damn near wiped me out and had to start over again. But, you learn, like, you get to this point where you're like, I never want to experience that again. So I'm going to do things completely differently now. And I think that a lot of people discount the value of those kinds of experiences and how much it changes you, and how much it actually, changes you for the better.
Yeah, I mean, I think a lot of us are like, oh, we read a book. Oh, this makes sense. I want to do it. Jump in and get a couple of good deals, and then bam, then lessons are learned. And those sometimes lessons are really, really hard. If you were someone like me, maybe you, that dove in head first, like, I like this. I want to do this. I got this. I got a couple good deals, so I must be great. And then, and then things shift and change. I also could see that things were frothy and didn't make sense in 2008. And that's why we helped so many investors go to places like Texas, where it was going to, at least in the single family realm, we were going to stay out of the storm. And many of the people who listened to me, kind of like you, did great because they were buying rental properties in Texas, where there was still tremendous demand, job growth, and so forth. So many people do the opposite. They don't have, or maybe they don't listen to their gut, or they don't know enough. Because wouldn't you say it's like when you were starting to pull out and get cautious, that's when masses were pouring in 2006, 7, 8. But right when you were kind of like, something's not right. Same with me. Something's not right. I'm going to tell people to sell in these bubble markets and get into more of the linear markets like Texas, where they can protect their assets. Why is that?
Well, it's the psychology of the market, right? And that was exactly what I saw. Was in 2006, I would go to real estate club meetings, like REIA groups, like local REIA groups, and everybody was like, I've got to buy a rental property. My plumber just bought one for $1 million, and he just made $150,000 in equity in the first year. I've got to get one. And I'm like, well, why would you want to do that? I'm like, because right now a rental house will cost you $500,000 and they rent for $1,500 a month. Tell me how any of that makes sense.
Just doesn't
I
make
got to
sense.
get one,
Yeah.
And that's when you're like, okay, this is getting ridiculous. And that was the same thing that I saw in 2021 in multifamily. We were getting outbid on multifamily properties left and right by millions of dollars. And I thought to myself, you know what? This is 2006, 2007 all over again. Here we go. Something bad is about to happen. And people will pay any price to own this real estate. And it just so happens I own a bunch of this real estate. And if they want to pay me that price for it, why should I stop them? They should have it. And so we started selling left and right. We sold 3/4 of our portfolio. It was about 3,000 units in about a year and a half, 2 years time, right before the collapse in what I would say is second quarter of 2022. That's when the multifamily market really started to tank. But it wasn't because I was seeing like, I had this crystal ball of interest rates were going to go up. That wasn't why. It wasn't because I saw there was going to be all this massive construction and data was telling me that I needed to do this. It was market sentiment that gave us the flashing warning signal that it was time to start selling. And I think that's what a lot of people don't pay very close attention to.
Well, I mean, it's more than that. I mean, you could see the underwriting was nuts, right? Like,
Yeah.
it didn't make sense. There was nothing you could have bought in 2021, 2022 that would have penciled, because if it did pencil, you were going to get outbid, right? There was just no way you could land a deal.
Yeah, and why was the underwriting bad? The underwriting was bad because buyers were trying to force a deal out of one that wasn't really there. And so the only way they could make this deal so-called pencil was by financial engineering. using massive amounts of leverage with bridge debt to try to juice returns, multiple share classes where they have A, B, and C and D shares with different levels of participation to try to drive up their rate of return on subordinate shares. They're using mezzanine debt and preferred equity and just all kinds of different things, as well as enthusiastic or overly enthusiastic rental growth rates and inadequate expense growth rates. And so, yeah, the underwriting was terrible, but the underwriting was terrible because of the same very reason. It was because of that market sentiment being so hot that they felt that's what they had to do in order to get something to pencil so they could get a deal, quote unquote.
Yeah. Yeah. It was the only way you could acquire. And of course, a lot of those people are licking their wounds now. And like you and like me, hard lessons learned that they will probably never repeat. So here we are now in 2025. Where did the time go? It's been 5 years ago since COVID. I don't know.
Right?
Anyway, here we are in another cycle. And there's winners and losers as always. And I don't want to say that, people should pivot whenever the market changes, but sometimes you kind of need to. So I know you're pivoting. What are you doing today?
Yeah, I've long been a believer that the real estate market, if there's such a thing as the real estate market, that the real estate market is really like a stream that meanders through a meadow, right? When you see a flat meadow with a stream, what does the stream do? It curves left, it curves right, and it winds its way through. And if you're in a rowboat and you're just rowing and all you know how to do is go straight, you run aground. You have to learn how to follow the current, turn left, turn right when that's what conditions are telling you have to do. And that's why I transitioned before from flipping to buy and hold. I transitioned from that to multifamily. I transitioned in development because different things are working at different points in time and at different places in the cycle. And that's what I saw now. So that's when we started selling multifamily for 3.5 years, I didn't do really anything. And there was nothing to buy, nothing penciled. So we've been sitting around. But recently we made
I know you weren't sitting around. I know you weren't sitting around.
Yeah, all right, fine. Maybe that's not quite the most accurate definition.
Perhaps a little travel, perhaps
doing a little
house.
travel, spend some time on the beach, work on my golf game, and and still having to do work because we still did own 1,000 multifamily units. We had to make sure that we were maximizing what we could get out of those, given what market conditions would allow. So I still had some things to do, but nothing to buy. And then earlier this year, I got the opportunity to get into this assisted living, skilled nursing, and memory care space. Which is just so timely given the demographics. And the opportunity was it was perfect in so many ways and on so many levels. I had to jump on it. So now here I am, back-to-back meetings and recordings and podcasts and a full inbox, just like my life from 5 years ago. And I'm like, what am I doing here? But it's such a compelling opportunity. I just couldn't let it go.
So this is the question I have for people like you. Like, why? Like, you could stop and just play more golf. You could, as you said, sit on the beach more, hang out with your wife. Why do you keep going? Why do you keep doing?
Well, I do all of those things still, even amongst all of this. I managed to squeeze it in. I've got a much better work-life balance now than I did in my younger years. But the why is really because I don't know. You probably get this more than anybody, Kathy, is I just love what I do. And it's enjoyable for me. To me, it's not really work. I like giving my investors an outlet to kind of accomplish their goals with their investments and their retirement planning and stuff. And we can play a small role in that by making them some money and doing right by them. And that really drives me. And, we've got a lot of clients that have invested with us for many, many years that have been asking for the last 5 years, when are you guys going to give us something else to invest in? And I'm like, not yet, not yet, not yet. And finally it's like, okay, I found something. And if I found something I think is right for them, I'll make that move. And, I'll do it because I like it and I get to give them that opportunity. And that to me is rewarding.
Okay. Yeah. I mean, one of our partners on our development deals, Fred, a lot of our investors know who he is. We've done so many deals. When I first met him in 2009, it was his third time retiring. And he was like, I can't sit back and look at all these opportunities. He would go into Bank of America, into the commercial division, and there would be boxes and boxes and boxes of foreclosed subdivisions and developments and land at 10 cents on the dollar. He just was like, this is more interesting to me than golf. He's like, you can only play so much golf. So, I get it. That was what he did as well. And when opportunities there, and you kind of have spent so many years perfecting your craft, you don't want to just sit back and not use it. So I get what you're saying. The amount of advice and wisdom we both have gained over I guess you longer than me, but over the years, decades that we've been doing this. And the deals you're getting are incredible. I want to understand senior housing. It just seems complicated and hard, even though I know it's one of the most needed things out there. So how do you learn a new thing, a new skill, a new trade? I mean, you said like the real estate market, when you bring in something like senior housing, is it really the real estate market or is it a business? It seems different.
It is different. You're right about that. And it's both. It's both real estate and a business. And that is a whole new learning curve. And,
Yeah.
I learned a long time ago, there's a couple different ways to learn something new, right? You can read a book or go to a course or, study up. That's one way. And the other way is to bring in an expert. And what I
Yeah.
found is all the times where I tried to learn things on my own and figure it out on my own. More often than not, I was successful at doing that, but it took an extraordinary amount of effort and time,
Yeah.
and it made it just progress very, very slowly. So I realized, years ago, it's far better to bring in an expert, and part and parcel with this new opportunity. The way I found out about it was through a friend of mine who's been in the business for over 20 years. I've known him for 25 years. We used to do things together back in my very early house flipping days. He was my right-hand guy. And,
Mm.
when he quit doing that, he went into senior housing and went to work for a company as an acquisitions associate, worked his way up the ladder to vice president of acquisitions, and then later ended up switching companies and worked his way up the ladder there and became the president and CEO of a healthcare REIT that did nothing but buy assisted living, skilled nursing, and memory care. And one day he realized that he really needed to start his own thing, right? And not just work for the man, so to speak, but to to be
Mhm.
entrepreneurial like we all love to be. And that's when he came to me earlier this year and was like, hey, this is what I want to do. I've already got some deal flow. All of it's off market. Do you want to team up on this? And it was a perfect opportunity to bring him on my team and say, here's a guy with 20 years experience, $1.5 billion in acquisitions, having, overseen dozens and dozens of facilities for like 10,000 beds. I could read books and study and all this thing for the next 5 years and maybe figure it out. But by then the opportunity's behind us. Or I could bring him on and we could accomplish this together and we could do a lot in a very short period of time. And that's in fact what we've done in 6 months time. We've bought 19 properties in 18 cities in 4 states for over $140 million. That's a lot in 6 months. And
Yeah.
if you're trying to learn it on your own, it's going to take you longer than that.
I couldn't agree more. Why try to figure it out yourself when somebody else has already spent 20 years figuring it out? Partnerships are so important. So coming back to the newer investors, the people still building, if you could remember what life was like when you're wondering, how can I replace my income? How can I retire someday? What is going to give me more financial freedom than I currently experience? For those people, what kind of advice do you have? A lot of people are scared. If we're just going back to home prices, which is what Real Wealth is known for, helping people build a single family portfolio, we have high prices, high mortgage rates. It's hard. It's not like when we started, although when we started, things weren't that easy either. So what's your advice to somebody in that position?
Well, the interest rate on my first home was 8.5%. So, anybody who wants to complain that rates are too high today to make, buying real estate worth it, just doesn't have a sense of the history of real estate. This is,
Yeah.
it's times when the markets seem the most fearful is probably the best time to be buying. And I think, right now there's opportunities out there because you don't have to compete with the, highly experienced people buying up everything. There's actually a lot of inventory on the market, and you can, make offers and, get good deals. And if you're willing to get your hands dirty and get in there and work for it, you can do very, very well. And it doesn't take a lot. See, I think that's something that a lot of people don't realize. But what it does take is it takes time. So I think people need to set their expectations accordingly. I think one of the most important things for new investors to realize is that this is not a get rich quick business. And a lot of people go in there thinking, I'm going to replace my income, and within 2 years, I'm going to quit my job, and da 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 da. That's not how it works. Think of this as a get rich slow business. And if somehow the market and your efforts give you a real gift and you're able to quit your job, then that's all the better. And I can kind of give you a roadmap to what that looks like, because I did it. Here's what it looks like. I spent about 5 or 6 years flipping houses, and before I got to the point where I said, the job is interfering with my house flipping business, I need to quit my job. So I did. About 2 years later, I was realizing that I had a couple of houses that had appreciated in value. I did a 1031 exchange into my first multifamily property. I owned that multifamily property for 15 years before I finally sold it. While I was doing that, or just after I did that, when the market seemed horrible, I went and bought an 11-unit apartment building clear on the other side of the country in Buffalo, New York, of all places. Why? Because the markets were like, it was scary. And I thought, here's a place where nothing ever goes up, nothing ever goes down. So I don't have to worry about it, right? I can buy this thing. So I bought an 11-unit building for like $300,000. And that was like impossible to find back then, but I found it because I was looking. You're out there looking, and when you look, you find. I bought this thing with almost no money down. I had the seller carry back the mortgage. I put some work into it to fix it up, bring the rents up, and I still own that building to this day. And last month, I made my last mortgage payment. Wow. And so now the thing is owned free and clear. I bought it for almost no money down. I own it free and clear. It brings in $11,000 a month in rent.
Oh my goodness.
If I wanted to, I could retire and just live off of that, right? Anybody could probably live off of that in a low-cost area, at least if that's the only thing you ever did. And that wasn't all that complicated. I mean, that whole roadmap I just gave could be done in like 15 or 20 acquisitions over a period of 4, 5, 6 years, and with not a lot of your own money in it. And that's how I did it. And if I could do it, anybody could do it.
Yeah, what the key of what you said is it's not 2 years, it's not next year. Unless you have $5 million you just inherited or you sold your business, you're fine. You could invest your money and retire. But for most people, if you have 50,000 to invest, if you have 100,000 to invest, you're not going to be retired in a year or two. I love what you said. It took you 5 or 6 years. For many people, it might be 10 or 12 years if they're less active. If they're doctors, a lot of our members, a lot of our listeners are doctors, dentists, tech people. They make plenty of money. They just don't know where to put it. So understanding it takes time. It takes time. It's not, maybe there were a few years in the past decade where you could do it faster. Maybe if you bought a multifamily in 2019 and sold it in 2021, you'd be done, out of the game. But now we're in a different cycle. So let's talk about that. What would you say this economic cycle is like? Is it compared to any that you are familiar with in the past, or is it just a completely new ballgame?
Well, they're all a little bit different, but they all have some, family resemblance. And, right now, I think, I feel like right now is maybe, 2010-ish. Where especially on multifamily. Single family was totally different. Single family, this is just like any other year. I mean, the market's a little bit slow. The single family market reminds me of 1993. Because the prices went up in the late 80s. 91 prices stopped climbing, and then they leveled off till 97. So literally from like 91 to 97, prices didn't move. Single family home prices, they just didn't move. I mean, maybe the percent here or there or whatever, but nothing really major. Multifamily, this reminds me more of like, 2010, there massive fall. Prices have fallen like 40% in multifamily. There's going to be some massive opportunities coming. Lots of loan defaults, I think, are coming, and that's going to spell a lot of opportunity. So the way the market is different is that different sectors of the market are resembling different past cycles in different ways. But, you mentioned about a minute ago about how people who want to be able to build a portfolio and so-called retire in a shorter period of time. The ones who have been most successful at doing that are ones that are buying in markets kind of like this, where then the market turns around and gives them a big boost in a short amount of time. The ones that it takes forever are the ones that are buying at the top, have to ride it all the way down first and then ride it back up. So if you're just getting started in this business, this is a much better time to get started than it was, say, 3 or 4 years ago.
Absolutely. Oh my goodness. Totally, totally agree. Very exciting. Okay. So for the next 10 years or so, I mean, do you have concerns about a recession? 10 years is a long time period. So probably the answer is yeah, we'll probably see one. But do you have concerns that we're heading into a deep, dark stage for the US in terms of the economy?
Well, I'm not really fearing anything deep and dark. I do think there could be a mild recession. But I think that every recession has a different face. And sometimes people think like, oh my God, a recession, I can't buy real estate because there's going to be a recession. And that's going to mean that the real estate's going to go to zero. No, that's not really what I mean. Recessions look different. Some recessions affect real estate heavily. 2008 was an example because real estate caused the recession. And so therefore real estate took a massive hit in that recession. So when people think about recession, they think of 2008 and they think that's what it looks like. Well, no, there was also a recession in like 2000 from the dot-com bubble. And that didn't affect real estate at all. I owned real estate then. My rents were fine. My units were full. Prices were going up. Real estate didn't even bat an eye at the 2000 recession. So they all look different. I think that if we see a recession soon, it might look more like that one than it does 2008 or 2009, because we've already kind of taken some hits in real estate. And I think we'll climb our way out of that, even with a recession.
Yeah. Oh my goodness. Such good stuff. I could ask you a million more questions. I'll just ask you one more. Since we do have our multifamily fund and we're excited about finding those deals, like you said, that are much, much cheaper than they would have been just a couple of years ago, what are the biggest lessons you've learned over the years of multifamily? That's a huge question, but the ones that come to mind first.
Well, the biggest issue is, if you look at a lot of multifamily syndicators right now are in massive distress, and a lot of the distress that they're in has been caused because they took on short-term loans. People think it's floating rate that's killing them. Not really. What's injuring them is their maturity date. And so, I think a big lesson I learned a long time ago is if you have enough time, you can get through any kind of a cycle.
Yes.
Right.
Mm-hmm.
And so when people buy at the top of the market cycle with 3-year loan, if there's any kind of a hiccup in the perfection of the market at any point within that 3-year period, they're toast. And, their fate has been sealed. There's really there's no way out. The best thing you can do for yourself is to give yourself plenty of time. And if you have a loan with a 10-year loan maturity, even if there's a recession or a reset in the real estate market or an adverse market cycle during that period, you've got plenty of time to get through to the other side of it. And I think that's what's most important, is make sure you don't paint yourself into a corner. Give yourself plenty of time. If you want to buy multifamily, do it at the bottom of the cycle, not the top of the cycle. I think a lot of people are regretting the purchases they made in 22 and 23. But if you buy something now, you're going to be in a much better position. Now, I've been a critic of multifamily for a few years now, and I've been not silent about that. But I believe that there's a needle in every haystack. And that's what I like about your multifamily fund, is you've kept the fund small enough where you guys can fish for needles in haystacks. You're not trying to go out and build a 20,000 unit portfolio of, Class A stabilized multifamily. You guys are being opportunistic and trying to find the needles in the haystacks. And when you find them, and you can do it in any market, especially in the bottom of a market cycle, is the best time to execute that strategy. And you can be very, very successful. So I think people that are out there looking for that kind of stuff, this is your market. It's time to do that.
Good stuff. All right, Brian, thank you so much for joining me here on The Real Wealth Show. We will have you back.
I can't wait for it. Maybe in another 10 years.
Hopefully sooner. All right. And if you want to start your passive investing journey and find out about our multifamily fund, just go to realwealthshow.com and click on the Invest tab. There you'll see our current offerings. We're so excited. We're also launching our single family rental fund. It's our second one in the North Dallas area because investors requested it. The first one's going so well. Again, you just go to realwealthshow.com and click on the Invest tab. I'm Kathy Fettke. Thanks for joining me here on The Real Wealth Show. We will see you on the next episode.
The views and opinions expressed in this podcast are provided for informational purposes only and should not be construed as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, go to realwealthshow.com.